Okay, so let's skip down here. What does it say? After advancing in the first half an hour of the session, the market spent the remainder of the day doing not much other than drifting sideways in a relatively tight trading range. Moderately positive sentiment, as exhibited by the market's ability to maintain its standing in positive territory, was founded in an unwinding of the geopolitical risk premium baked into the market ahead of the long Easter weekend. Blah, 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 and all the different sectors that kind of supported it. Interestingly enough, the advanced decline on the New York ended up at 16 to 16, and the advanced decline came just a hair more bullish on the NASDAQ. We had been looking at it all day at 17 by 13, 17 by 14. It became 18 by 13, so a little bit, few more advancers. But that certainly isn't a strong bullish sign. What we want to see is on a really big day, we want to see 2 or 3 to 1 advancers to decliners, or vice versa. Okay, like I said, I don't want to bias you guys to the long side. I'm not by any means. I still think there's a lot more things to sell out there than there are to buy. But this certainly is a flat day, guys. It's just that simple. Dow's up 69, 70 points, and that's what? Less than 1%. So it's not very exciting. Okay, any questions or anything before we get started back into the slides? Anything you guys want to talk about, the platform or anything like that? You guys are just too vociferous. You had a good lunch. Well, I have to try to keep you awake, and we're going into technical analysis, which is not the most wakeful thing, but we'll try. Alrighty. We've had a couple of little talks on technical analysis, and the first concept that we need to talk about is that the theory of it is that everything that is known or is knowable, okay, about a stock should be reflected in its chart. Now, our problem is that it becomes an interpretive art. There is no science to this. So our ability to interpret that information, what is known or knowable, is our real skill, okay? The chart's supposed to reflect the people's actions or reactions to things they know, they think they know, or have merely heard. As it says down there, you've heard buy the rumor, sell on the news. And rumors do not have to be true to have an effect. And I think some of you guys have been around long enough that you've heard some of these horror stories. It was about a year and a half ago. There was a young kid, got himself upside down trading other people's money, about $270,000. And he went out and he copied a Bloomberg.com news bulletin. And he put in there a company's name. I think it was Pargain. And he said all sorts of horrible things about this stock. And he published it onto the news site, onto the web, internet. And it got into a bunch of chat rooms, and boom, in no time at all, Pargain was cut from $84 down to about $46 in about 15 to 20 minutes. Alrighty? Well, everybody went nuts over this. Alrighty? And Pargain came out immediately and said, listen, none of the things that this guy is saying are true. And something like 25 minutes later, CNBC, to their credit, came on TV and said, ladies and gentlemen, we have not been able to verify, deny, or confirm that any of this is true. Please hold tight. Pargain rallied up from that point to about $57, and that's where it stayed. Well, there was $30 worth of equity times millions and millions of shares that were just washed out of existence and because of this. Turns out, to make a long story short, okay, the kid did this. He got caught. He's in jail already. The SEC found him. He was one of only a few people that went short Pargain that day, and he really loaded up. So he stood out like a sore thumb. Alrighty. Now, the real question came, and I thought this was very philosophically interesting, was that a lot of people complained very bitterly to both the NASDAQ and to the SEC. And they said, well, wait a minute. We were hornswoggled. We were taken to the cleaners. This information came out, and we want these trades busted. We shouldn't have to endure this. And the SEC came out and said, ladies and gentlemen, if you're willing to take the risk and make trading decisions based on flash news over the internet, that's up to you. Let the buyer beware, caveat emptor. And they didn't bust one of the trades. Okay, so here was a young man who, through some financial difficulty, broke down a company, which, by the way, is now trading somewhere around $7 or $8 and has never recovered already. Millions of equity were wiped out already. And Pargain, P-A-R-G-A-I-N. And like I say, this occurred about 1.5 years, maybe 2 years ago now. Time flies when you're having fun. You start losing a couple of gray cells, and it might be 2.5 years at this point. But it's very important that you understand that we deal in perception, not in true reality. And there is no actual fact up here. All we are seeing in this basic chart is a line of people's emotions trying to expect and fulfill their needs over time, okay? And the famous old question, what is a company worth? Pick somebody. What is IBM worth? Well, we don't know what IBM is truly worth until we completely disassemble it and sell it for parts at the open market. Right now, it's valued at around $93 a share because that's what one person's willing to buy it for and another person's willing to sell it for no other reason. If tomorrow, and a lot of times people ask me this question, they go, well, Mike, where do gaps come from? Why do stocks gap up? Why do stocks gap down? Because of a change of opinion. Certainly, if Microsoft closes today at $28 and it opens tomorrow at $25, well, my gosh, how many trillions of dollars of valuation would that be? You think of how many outstanding shares they have times $3, that'd be a huge drop. Is Microsoft overnight changed its value? No, just people's perception of its value have changed, okay? And if I say, well, I just won't buy Microsoft except you sell it to me at $15. Well, nobody's going to do that right now because they can get either 27 or 24 for it, okay? But if everybody grabbed a hold of my idea and said, well, Mike's right, we're only going to pay 15, guess what Microsoft's new price is? Boom, big gap, okay? Then somebody would step in and say, well, we oversold it, we should buy a little bit back, da-da-da-da, and the things would start to find the happy median again. Everybody understand? Now, today we did a small exercise talking about building a trade plan based on support and resistance. And it's very, very important that you undertake this into your heart and mind, okay? Because support and resistance lines really define where people either made money or lost money. They are lines of wins and losses. They are battle demarcation zones, and they're full of emotion. So this is why we find price levels which were the turning points in the past. People either made money or they lost money at this specific price, and they remember it. And when it gets back to that price, they do the same or they do the opposite depending on what their past experiences were. The most valid lines will have been both support and resistance. What is resistance now will become support in the future, and again, even further in the future, will become resistance again. We take this stand here at OTA that the majority rules. We don't worry about the very, very fine tips. Again, when we first talked about support and resistance, I told you that it was a zone. It's not a price. When we say support's at $30, there is no demonstrable difference between $29.95 and $30.05. And at any given time, there's a push and shove between the buyers and the sellers, between the red coats and the green coats, if you will. So there's always a battle going back and forth. So if we look at some of the little older technical analysts, these guys really like taking the very tops of the shadows, the very top of the range bars, okay, the very bottoms. But we found that in electronic trading, we get enough bad information, Okay, and we do appreciate that these are zones that we're looking for the majority of the trades along a line, not the very exogenous points. That's what we mean by majority rules. And of course, the most important thing about perception is that the more people that perceive it, the stronger the reaction. So what does it say down there? Don't squint. If you can't see it, then somebody else can't see it. And if they can't see it, they can't react to it. This also goes back to our discussion about the validity of time. We know that price is fractal, that the rules apply for a daily chart are the same rules that apply for a 1-minute chart. But in a 1-minute chart, there's not as much statistical evidence, there's not enough trades going on to give it any real true value. Yet on the course of 180 days, there's a tremendous amount of statistical data. And I think we talked about this in the terms of coin flips. If you flip a quarter 100 times, how many times will it come up heads? Well, the standard answer is 50-50, but that's not correct. Statistically, it'll probably come up something like around 35-65, one side or the other. Flip it 1,000,000 times, and it'll be so close to 50-50, it gets scary, okay? But I doubt that it would still be perfectly 50-50, 500,000, 500,000. You ready? So we always have to think about that statistical probability in there. Now, again, what are we looking for here? We're looking for support and resistance over time. And here we have a weekly chart of General Electric, okay? And certainly, I left this chart in here for purpose. We're back to 1999 and 2000. And we can see the low for the last year or so is down there at around $32.50, $33, okay? And that is going to be a support line if the price came back down, which it did. Okay, but it went below that. Where do you think General Electric is stalling right now in 2004?
32.
Right at this line, about 32, 32.50. Okay, it's hitting its head against this what was support 4 years ago. Okay, is now becoming resistance right now. And again, what we're looking for is periods, and appreciate that we're talking here about weekly charts. So we've got 1, 2, 3, 4 weeks, over a month, okay, of resistance, alrighty? Later, several months later, we get 1, 2, 3, 4 weeks out of 6 that it finds it as support. It's very important that you guys start to see this. Again, you'll note that we didn't pick them so that everything is perfectly within. We have this little guy sticking up here. We have this little tail sticking down there. Because a couple of points, a couple of pennies either side, I want to find the majority of the trades. Where was the majority of their highs? The majority of their opens, okay? So again, here's some other examples. Again, we find a couple, 2 or 3 weeks of resistance here. Months later become 3 or 4 weeks of support over here. And again, here's just some more examples. We find what was resistance becomes support, later comes back, and we find its resistance again. Obviously, the more times that this line is crossed and broken and tested, the stronger and more apparent it becomes. As I said, this is a demarcation of a battle zone. Somebody won, somebody lost. If we see that the buyers break through resistance after several tries, we say they won. What did they win? Here's our resistance line. Buyers come up, they hit their heads against it, and they finally come through. What did they win?
The battle.
The battle? The honor? Was that what the battle? To the battle, to the winner go the spoils of war. What are the spoils? They bought it here, and somebody tried to force them to sell it here, but now they can sell it up here. Did they make money? Sure. They took their battle to this line, and now here's the honor or whatever, the face. They said, we think it should go higher, and they were right, and the sellers were wrong. Okay, so they won money and honor, if you will, or face, or decision respect, whatever you want to call it. Okay? Conversely, what did the sellers lose? Did they lose money? They sold it here. Ah, very good. They didn't lose cash, they lost potential money. Had they not sold it here, they could have been selling it up here. But also what happened? Did they lose face and honor? They said, we're holding the line, and the buyers proved them wrong. Okay? So what happens is later, as price comes back down here, this resistance line starts to become a support line. And support is defined as a price that finds more and more buyers. Well, where does it find more and more buyers from? The buying pool over here? No, that's the same amount of buyers. But have we converted any of these sellers into buyers? As this comes down here, they say, hey, the last time it was here, had we bought, we would have been heroes. So we add their ranks to the file, and suddenly we have a support line. And here's some more examples. We've been looking at weekly and daily. Here's an intraday 15-minute chart, and we can see on these 3 days how nicely the price comes up and hits resistance 3 times. Then it skips a couple days, and the 3rd day out, it becomes support again. Guys, one of the things that we really want you to do is to take the time and write down support and resistance numbers in your favorite stocks as you find them, because they become more and more important numbers. And this is why this morning, when we first started talking about our trade plan, I showed you, let's layer them out. Let's show an R1, R2, R3, S1, S2, S3. Maybe we put them on an Excel spreadsheet. What if, after the course of 6 months of playing Cisco, you look down and you say, I want to sort on my Excel spreadsheet for 2427, and it comes up 100 times in your spreadsheet, and no other number comes anywhere close to it. What do you know about 2427? Is that an important price line? Yes. Absolutely. Absolutely. One of the things that you guys, as beginners, need to get a grasp on is price levels. Now, I can sit here and looking at the platform today, I already know that my next major overhead resistance, super resistance in the S&Ps is 1162. And the next one down from that happens to be 1150. We have one at 1144. Support right now, 1142 and a half, 1132 and a half, and 1109 super support. How do I know that? Well, I live it. I trade with these numbers every day, and they become part of my being, of my mental capabilities. But how do you know if 2427 is a good number in Cisco until you observe it? Until you start trading with it on a daily level, then you will start to have it. So whatever your stock is, it's very important. Remember, guys, it's easier to read than it is to remember, particularly as you start to get a little bit of gray up here, already. If you have it written down, it's easy to go back and go back over it. Good S&R levels jump off the chart at you. Again, I want you to note here that we're not being real picky about grabbing the very, very tips. Yeah, we can get this real fine 2 points here, but I'd miss this guy over here. I'd miss this guy in here. I'd miss this little guy over in here. I want the majority of the trades. I want to know where the major battle was fought and who won it and who lost it, okay? That's going to be important to me sometime in the future. And by the way, has anybody heard of Tony Turner? She's a pretty good author and trader. She wrote a Beginner's Guide to Day Trading, was her first book. She's had another one come out. And she came out for this stuff here, and it was just so perfect. She has a technical term. It's called dangly stuff. It's perfect. That's what this is. Technically, it's called dangly stuff. Okay, now, those are horizontal support and resistance lines. Can we have angled support and resistance? Sure enough. And we kind of refer to those as trend lines. Now, as a quick refresher, when we talked about this originally, I defined an uptrend as a little bit more specific than you're used to reading in books, okay? An uptrend is a series of higher lows in conjunction with higher highs, but higher highs aren't really required to continue the trend. Okay, you'll read a lot of books that just say higher highs and higher lows, but it gets a little bit more intense than that if you look at the true definition of an uptrend. And a downtrend, therefore, is the antithesis. It's a series of lower highs in conjunction with lower lows. If you do not understand the definition to these trends, then you're going to miss some major things. So just a quick recap. By understanding the definition, we can finally tell when our trend is truly broken or when it's just weakening. If an uptrend is a series of higher lows in conjunction with higher highs, that's cool. But if higher highs aren't required, then the only thing that is required is higher lows. And this is why we draw our trend line on the bottom of price going up. And conversely, a downtrend is a series of lower highs in conjunction with lower lows, but lower lows aren't required. And therefore, we can draw our line down on the top of price. Again, here's some higher lows. An uptrend is not broken until I get a lower low. Does that mean a downtrend is in place? No, it just means the uptrend is broken. And conversely, once I get a higher high in a downtrend, then the downtrend is broken. It doesn't mean we're in an uptrend. Okay, we then have to search for definition again. Now, the most important thing about trends is that trends tend to continue. Newton's third law of motion says that an object will continue to move in a straight line unless acted upon by an outside force. Trends will tend to continue until acted upon by an outside force. What is that outside force going to be? News, geopolitical events, earnings, that kind of stuff. Okay? You got to learn to trust the trend line. If we're going to draw a line, okay, and here we picked up this top and this lower high here, okay, and then extended it off into time. Once we draw a line, we need to set a rule. Now, this rule can actually be the incorporation, the complete incorporation of a very simple trading plan. On a downtrend, what would we say? Well, we use general rule number 2 and say we sell near resistance because this is on top of price and therefore it's a resistance line, and we buy near support. And well, we don't have any support, maybe we go down here or go back a while. And then we could put a rule onto it and say if we get a close above that line, we close the trade. So this now tells me that I can open, after I draw these 2 points, I could get short here or here, and I stay short until I get a close above that blue line. Is that a simple plan? Yeah. And the most important thing about simple plans is that they take the burden of your emotions off of the decision-making process. When you start moving back up here, you don't have to go, well, will it go back further? Will it go up further? What should I do? Where shall I get out? It's very clear. If I get a close above this line, I'm out. No ifs, ands, or buts. Okay, well, did we make money? We sold it up here, we bought it back down here? Yeah. Could we have made more money? Yes, but not under this plan. We'd have to have a more refined plan. And that might include candlestick theory or knowing that this was a major support line. There's a lot of other ways to add to it, but I'm trying to show you that a trend line, by its very nature, with one simple rule attached to it, becomes a complete trading plan. It tells us what our entry is. It tells us what our goal is. It's an automatic trailing stop. Does everybody understand that concept? That as time goes forward, I am required to make more money. Okay? Because it's slanted down. And if I'm short, I'm going to continue making money until I break that line. So that by its own nature is what we call a trailing stop. Now, here's where it gets kind of fun. All righty? We get our stop out over here, and then most people say, well, I want to go long. But you're still bucking the trend because you're not watching carefully. If I were to throw a horizontal line on these highs and this low over here, you would find that this high is lower than these guys. That there is a support resistance line right in through here. Let me demonstrate that for you. So if I were to put a line right in through here, and we move it up so everything touches, How about that? Can everybody see that there's still a white gap between this highest tip and that black line? Can you see that what we created as resistance has been tested and failed? So the trick is, some people would come to me and say, well, Mike, we got out here, but I can still see a series of higher lows. But are we allowed to look for higher lows yet? Don't we have to first break our downtrend? Should we be looking for uptrends? Well, maybe if I'm a high-speed trader. But again, guys, let's not buck the trend. The easy answer is let's throw another line on here and continue to think short until we have a busted definition. And only then start looking for uptrends. So that's why it's important to go out and measure these things to see that truly that is not a higher high there. So that brings us back to this guy. What are we going to do? Or are we setting up here to trade on the 30th? No. We're going to extend this red line out into the future because I trust the trend, and tomorrow I'm going to be looking to get short. Well, Mike, today it gapped down. If we set up here, we couldn't get short. We weren't close to the line. Oh, okay. But we did draw this line in through here horizontally, okay, and these two were right on it. So could I sell close to this resistance line and still use this one as my stop out? Somebody say yes, so I know you're still awake. Yeah. Okay, so now we're going to extend this guy out, and tomorrow, whether it gaps up or whether it gaps down, we're going to wait till it comes close to the red line, and we're going to get short again, unless everything in the world tells us we're wrong. Now, here's a couple of ideas how we could do this. Again, we have our slanted down line. We picked up this spot and this spot up here. Where would we really get short? Could we get short here? Well, I also see a line right in through here. Do you guys see this one? Right in through here? So maybe we'd want to wait till it broke below this blue and below this guy. We wouldn't have much time to get short if we're going to get out at the end of the day. But that would be the logical entry on it. We saw the one that I just previously drew in here, and we got short somewhere in this neck of the woods, and we stayed short. Might we pick up the low of the day as support and buy cover here? Okay, yeah, we may miss this little bit here, but we're not waiting to get out over here. So just by adding a line or two, we start to improve our profitability. Okay, we start to limit our time at risk in the trade. Again, we didn't know that this was going to happen here. We just knew that we had support based on the basic low of the day. We got short here, and we bought cover here. It went down further. Could we have sold it again? Oh, excuse me, what's your job? Is it to buy and hold, or is it to buy and sell? Yeah, it's to turn it over. Remember, we're merchants, people. We need to be buying low price stuff and selling it for high. We need to be selling high price stuff and buying it back for low. But we need to be buying and selling all the time. So these are just a couple of different thoughts about how to use support and resistance along with trend lines.
Mike,
Yes?
my thinking is here, in addition to what you're saying, is you got a gap here, it dropped down, you filled the gap here, right?
Yep.
That gives you reason to think that it has less reason to continue up at that point. I tried to go up here, then you got the red, and then you got a support down here from over here. So that gives you a reason to think, okay, you got this line here, gives you more reason to think that it's going to probably go down and bounce off this line, right?
Well, let's talk about that for a moment, because I think you may have something a little confused on gaps there, and I want to make sure you're clear. If the thing gapped down and we did get 100% fill, did we not? We got 100% fill. Wouldn't that kind of show strength for the day? We'd only really want to see this thing come up 38.2 and then fall back over. But it actually did fill 100%. Now, I agree with you. The next little top in here immediately becomes lower, and we start to get a sell-off, confirming that even though we got 100% fill of the gap, this thing was still under trend.
All right, so what I'm thinking is that you had an impetus here, you had a mind for thinking that gap needs to be filled, they filled it, and it lost speed here, and so and then it just this line continued to take it on down from that point on. That's what I'm thinking.
Yeah, I agree with that. I just wanted to make sure that when we were talking about the gap fill itself, this is contrary to gap fill behavior, because usually weak stocks wouldn't fill that much. Okay, but it did. But I agree, it still didn't come anywhere close to resistance before it started weakening again, and we started getting lower highs right in through here. Now the next point is we talked already about trend reversal patterns. We talked about if we had a downtrend and we had a double bottom, that would be a trend reversal indicating a move back up. Well, here's where it touched once, here's where it touched two. One of the fallacies in double bottoms and double tops, guys, is that they fail 64% of the time. They're nowhere near as good as a coin flip. But when you ever look at a double bottom or a double top in a technical analysis book, it always works perfectly. But the statistical evidence on it is about 64% failure in the field, as they say. So keep that in mind, because this might be a great opportunity to buy long right here. Ready? What does it do? You get hammered, okay? You're going, what? I got a double bottom, I'm in a downtrend. I have the possibility of getting back up to this resistance line, and it goes further.
Looks like you have a show between these 2 points shows that it should be going up off of here. It's angling up.
Mm-hmm. You can even make a small case for a lower high there, or higher low there. But you see, this is the problem. What did I tell you when we first started this? It's an interpretive art. Okay, I wish from my heart of hearts for you guys that there was an exact science to this. But you can all see that all we have to do is tilt our heads a little bit, and we all see it slightly different. And it's important that you understand that. It's not right or wrong. It's just important that you understand that. Ultimately, trends do start to change, and you've got to learn to trust them. Okay, and one of the interesting things is that here we had a sideways market. We're starting to pick up a little uptrend here. We've got a higher highs in this neck of the woods, so we can draw from here to here to here and start our uptrend. And of course, if we extend it, okay, it picks up these bottoms very, very nicely. So what are we going to do? Again, the general rule says we buy near support and we sell near resistance. And up here is the highs of the day. Okay, up here around 43.20 or so, and therefore we could get out, okay, as it comes up there. Is there another way to do this? I want you guys to start looking for patterns within patterns. And I'm going to sit down and draw a couple quick lines on this, and I think you'll be surprised. As an example, if I go down here, and does everybody see that I'm drawing a horizontal line that is a half an hour long? Okay? And by the way, I like fuchsia. So we'll make it a nice, pretty fuchsia color. All right. Oh, that needs to be thicker than that, don't you think? That's a skinny line. Pop that up to 2 points. There, everybody can see that fairly clear? Okay, now, just have an eyeball on this, okay? Does everybody see where the candle starts to move away from the blue line right here? Let's see, I can get that a little bit more exact for you, like that. And where does it come back? Is that just about a half an hour later? Okay, and of course, if I move this over like that, do you notice that that's just about where it comes back? It's about a half an hour. And if we look at this one moving away, do you see that's just about where it comes back, is about a half an hour? And if I move this like this, it hasn't quite yet. It's got another couple minutes before it comes back. People, you need to start looking for things like this. Now, this is just a timing pattern. I could do the same thing by taking this line, could I not? And making it a channel. So now I could do this. Because in either case, I could say what? If I were to buy it near the blue line, I could sell it 15 minutes later to get the high. Is that right? It was a half an hour long, so we'd sell 15 minutes, which should be the top of any one of these cycles. Ready? Or I could put on a channel line, okay, and say whenever it gets close to that channel line, well, sell near resistance. Now, the problem, of course, is with this channel line is what? It's really far away from these two cycles while it touches these two. So timing patterns have their benefit when you don't have a real clean channel in through here. Just a thought. Let me move that channel down here just a little bit for you. If we tighten up the channel like this, then we're starting to lose profitability. Okay? Up in this neck of the woods, but we're maxing it down in here. So again, as I said, if you're going to make a differential between channel lines and timing patterns, always have a quick look for timing patterns. And if you look back, you'll probably find that most of these guys are about a half an hour cycles in here, from here to here, from here to here, from here to here, okay? And that these things do have habits. They do have characteristics that they do time and again. Okay, again, if I draw a line, I have to put a rule on it. And perhaps we're using the close theory. So the question is are we out here?
Yes.
Yes, absolutely. We've got to have a discipline, people. Now, when we get into candlesticks, you're going to find that this is an incredibly bearish symbol, and it's telling us to go short. But because we drew the line first and it broke above it, we are constrained under rule to get out, even though it seems foolish. Okay? Why? Well, Mike, if we stay back in, we make a lot more money. I understand. But what's going to make you more money? Self-confidence in your discipline and obeying your rule every time, or taking advantage of one exception to the rule.
Discipline.
Yeah. Discipline, discipline, discipline. The rule 1 is follow the plan. Rule 2 is see rule 1. Okay, it's real simple stuff. So if our downtrend here said we must get out on a close above that line, well, sure enough, that's a close above the line, no matter how bearish it is. Make you sense? Good. With trend lines, we were just picking up a couple of tops or a couple of bottoms and saying this is the average angle of attack of this price. We can then move into moving averages, which are nothing more than curve-fitted support and resistance lines that are drawn by price via the computer. And we can use a couple of different types. We're going to talk about simple moving averages and exponentials, and I'll let you guys draw your own conclusions as we go further. First off, you'll read a lot of books that talk about a variety of different moving averages. Right now, the popular ones seem to be the 9, the 14, and the 40. Well, I was taught on the classic moving averages, which were 10, 20, 50, and the 200. And we've gone to lengths to categorize them for you by their strength. Now, I want you guys to think about this. A 10 period. If we're on a 1 minute chart, we're only averaging 10 times 1 minute, 10 minutes of statistical data. Not much. Okay, that's 600 seconds worth. Okay, so it's not really very much. So we say that this guy is about as strong as a screen door. It's not really designed to keep anything but light bugs out. Okay, if price wants to go through the screen door, well, if you had a Labrador retriever and he was outside and his bowl of food was inside and he was hungry, he'd just stick his head through the screen door. Okay? On the other hand, it's supposed to keep mosquitoes and light irritants out. Alrighty? So we tend to use the 10 as an alert line. We walk up to the screen door and we see a bunch of bugs on the outside and we go, aha, they can't get in, but I know there's bugs out there because I can see them through the screen door. You ready? The next one is our 20 period. And again, this comes to a shock to some people, But 20 periods are much like your front door at home. It's designed to keep honest people honest. Even if you have a deadbolt on your door, a professional burglar with a good swift kick or a crowbar is in your house pretty much at will. What it's designed to do is keep honest people walking by go, I wouldn't even think of going in that house. I know it's locked. But if somebody really wants in, if price really wants to have some sinister movement to it, it can penetrate it fairly quickly. So we tend to use the 20 as our first line of relevance, the first line that starts to trigger a signal. The 50 period is starting to get pretty beefy here, pretty sturdy. It's as strong as a block wall filled with rebar and concrete. Now, to get through a 50 period, you got to get into an SUV and hit it with a running start, or you need a couple pounds of C4. Scary. Everybody smiles at that. We all know what C4 is now. There was a time that nobody knew what plastic was. Anyhow, so this is really kind of keeping us honest, really honest. We have to do something really crazy in order to get through this. And of course, once we start getting up into the 200 period, as they say, it's the Great Wall of China. It's designed to keep the Mongol hordes out of the population. If the Great Wall's gone, well, Katie bar the door, okay? Jeepers, it's up. As it says down here, there's no extra charge for a 5 or a 100 PMA to put them on your screen. If you like them, use them. Now, there's no demonstrable difference between a 9 and a 10, very little difference between a 14 and a 20, and hardly any difference between a 50 and a 40. So if people want to write a book and say, this is the answer, it doesn't bother me, okay? You're going to kind of fit this to what you see in any case. So the answer again is, in your eyes, these are just guidelines. Now, it's important that you look at these guys and understand that, first off, it is a lagging indicator. Okay, there is no doubt about it. Now, at the top, on virtually every charting package, it will tell you exactly what you have up here. We have a dark purple 10 moving average, an aquamarine 20, a magenta 50, and a teal 100. If we look over here on the left-hand side, starting on 917 towards the bottom, about 11 or 12 o'clock, you can see where all the prices are in order. The 10 is closest to price, then the 20, then the magenta 50, and finally the aqua 100. Notice that as price moves up, how they spread out like the fingers on my hand. Now, this is one of the very first concepts of trading moving averages. And it's the expansion compression theory. As long as as long as moving averages are expanding, that means trend is intact. Where price starts to get waffly and starts breaking trend, then we start to see some compression. Now, we can't just trade it straight up. We got to think a little bit about what we're doing. So if we look over here, how about, guys, at somewhere right around 12 noon here, we can see that the 10, the 20, and the 50 are all three expanding, as well as the 100, okay? But the 10 is our alert line, the 20 is our first relevance line, and the magenta or fuchsia 50 is going to be our guide. So if the 20 compresses in on the 50, then we're going to get out of this trade. Where are we going to enter it? Well, how about we wait until we break above the recent highs of the day and we see expansion. So we could enter right about here. And we would stay long and stay long and stay long, and we can start to see the 10 period bending over right here. This puts us on alert for this big dip. Okay? But it doesn't tell us to sell yet until right here where the 20 starts to bend over. That means we're going to get out on one of these red candles right in this neck of the woods here. Remember, it's a lagging indicator. That line at the hard right edge is about one to 1.5 candles behind. Okay? See how the line stops here and the candle's over here? Well, this is on a 5-minute candlestick. So this line, the end of these lines, is about 2.5, 3 minutes behind that candle. But do you understand the concept here? Did we make money? We waited till we bought above resistance, which is now support. We bought it in here at around 25.30, okay? And we sold the thing out here around 20.30, and we sold it out here around 20.60, based on compression and expansion of the moving averages. Now, where do moving averages start to fail? Well, you can see at the end of 9.18 and 9.19 up here, how price is going up and down, and we start getting all these crisscrosses. That's another theory, by the way, guys. We could use a more reactive, in other words, shorter periods, and wait for them to cross over as buy-sell signals. But again, with the lead lag factor in there, it can get really confusing watching all these little lines. Again, as we approach 9.20, we have had a downtrend for the end of 9.19, so these guys are trying to sort themselves out. By 9.20, we have the 10 period close to price where it's supposed to be, the 20 next off, and then the 50. So we're back in order again, but going down. So again, we could go short in this under expansion theory. Where might we get short? Well, unfortunately, it gaps down, so we'll just take pot luck and say we got short here at around 20.75 or 20.60, okay, and we stayed short. The 10 starts to bend up right here, but the 20 doesn't start to bend up until here, so we're out right about here around 20.40. Again, another small winner based on moving average theory. Now, here we go again. We were just looking at a 5-minute candlestick. And again, here we are on a daily historical. Just to point out that prices are fractal, people. These are all set up as exponentials, okay? Now, what's the difference? Not much when they're all used together. I'll show you the differences between them. But right now, again, here we start to see on the middle of October in here, we can see the 10, the 20, and the 50 diverging. We might be able to buy it right here after this gap up on this candle or this candle, and we would stay long, stay long, stay long, stay long, until we started to get a bend down and we would get out. Again, we start to see them expand again towards the end of December. But may we wait until we broke above these highs and we buy right in here? And we stay long, 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 and it bends over and we get out somewhere up in this neck of the woods. People, we're making money, okay? It's not the most refined. We didn't get out at the very, very top. We didn't get in at the very, very bottom, okay? But again, it's a set of rules that allows you to follow something unemotionally. If you don't like my trend lines, maybe you like squiggly lines, okay? And that's what this is all about. We're trying to find something that appeals to you, that really you can take into your heart and say, oh man, I understand, I see that bend over, okay? I really understand that. And that's all that's important, okay? Again, we can see here, we got everybody moving, spreading out again. Might we get short somewhere underneath this little support line here? And we could get short right in here, stay short. Here's your pioneers right here, excellent, okay? Fall from here to here, right in here's your pioneers, okay? So this would be another opportunity to get short. We have some buyers in there. We stay short, we stay short. We see the 10 bend up here, but the 20 doesn't really hook up. Here's where the 20 really starts to hook up right in here, and we're out. Not bad, okay? Got short somewhere around 40, and we're buying it somewhere back around $25. $15 move, yeah, it took a month and a half. But anybody here going to sneeze at making $15? Okay? You know, even 100 shares, that's $1,500 in a month and a half for doing nothing. I pushed 2 buttons a month and a half apart, you know, I just, and watched a few lines. You have to watch the lines. Okay, again, you can see down here, this one's actually talking about the crossovers, already, where price really starts to move. Here's where the 10 is crossing behind the 20. Here's where the 50 is crossing over the top of the 20 and the 10. And finally, the 100 is crossing all 4 of them down here. It takes a while for all of them to get themselves straightened back out for a downtrend. So again, there's some people who actually use crossover theory, and when we trade tomorrow, we'll throw a couple up and I'll show you how to set up two really fast EMAs that give you some sort of signal. Again, assuming we have a market that has a little movement in it. Oh, please. Okay, real quick, how is a simple moving average built? Well, I don't want to bore you guys to tears, but literally, we take 10 prices, add them up, and divide by 10. It's that easy, okay? That gives us our first data point. Now, to make a line, we need 2 data points. We need 2 dots, okay? So what we do is we get rid of the first 10, and we add a new 10 in here, add them up, and divide by 10, and now we get our second data point. Now, the first one, if you guys remember, was 51.65. This one adds up to 51.25. So the trend is which way? Down, yeah, starting to head down. Now, Thomas asked a question about exponential moving averages. Now, using the same data we just had on the last screen that came out to 51.25, you guys can always cheat and go to the bottom right-hand corner and already see that this new data point is going to be 50.45. How do we get there? Well, we took the same 10 prices for periods 1 today through 10 days ago. But this time, what we did is we put some weighting on them. We gave some of them more value than others. And we simply did this by multiplying by 10%, because we're working with a 10 period moving average. Thank you. Okay, so the first price, we're multiplying it by 10/10ths, 100%. So it's achieving full value. The next price is only being times by 9/10ths, 8/10ths, 7, 6, 5, 4, 3, 2, 1, and 1/10. Okay, so this amount over here actually adds up to 277.47. We then multiply it by 10. That's where that 27, 74, 75 comes from. Okay? Now, obviously, if we divided this by 10, we wouldn't be anywhere close. So what are we going to divide by? 55. Because if you went 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, and add them all up together, that comes up to 55. So now we're giving some weight. We're giving full credence to this one. We're only giving 1/10 of credence to this one, and we're dividing it by a different factor. That's how we get this 50.45. Okay? What does all this mean? Well, it means that we get closer to price. If I went back, and let's do that for a second. If I went back, our last data period was much lower than all the other ones relatively. We were looking at 50s to 52s in here, 50s, 51s, 50s, 51s, and then we dropped it for the first time into the 49s. Here we got a data point of 51.25 arithmetically by simple math. But by doing it exponentially, that same data comes out and skews it to a steeper angle down, trying to touch that 49.50 sooner. So we get a 50.45. So to answer your question, Thomas, what do we do with these things? Well, if you've never worked with moving averages, I would recommend that you start and stick with exponentials, okay? Because they feel price sooner. They're more reactive. They give you a clearer picture of what's happening, not in the middle of the chart, but over here at the hard right edge. Remember, these guys are laggers. Can everybody see that the exponential moving average is the powder blue and the simple is the dark one? Okay, so here we see price going somewhat horizontally, and we get this big shot down and these 3 shots down. The powder blue one starts to bend right here. The dark blue one doesn't start to bend until a full day later. Okay, again, you can see where we start to see this shot up in here. Okay, the powder blue one starts to bend right here. The simple still hasn't felt it until about here. And of course, we can see where we have this sell-off. The powder blue starts to bend right in here from this point, starts to bend down right here. The blue one is actually still coming up a little bit from this. And then it starts to feel these last three right here. So exponentials give you a clearer picture of what's really happening in price. Now, I was raised on simple moving averages, and it's how I've always looked at price. And I'll be honest with you, I'm not going to change now. But as I said, if you're just starting, there's no difference. So you might as well use the one that's closer to the hard right edge. That makes sense? Now, I said earlier that moving averages were to act as curve-fitted trend lines. Well, here we could use the same rule. We've got a 10-period moving average, and it is an exponential, EXP up here, alrighty? And I've got a trend line picking out some tops. Now, if we use the same rule, whenever we're close to the line, we can sell short. If we get a close above the line, we must get out, okay? So here, let's say we have to draw at least 2 points. So we're going to get short right here underneath our moving average, or right here underneath our line. And we get a close above, we're out, we're back in, we're out, we're back in, we're out. Or under the trend line, we could get in here, somewhere in here. And is this a close above the line? No, it's not. That's an open above the line. For a close above the line, it has to be a green candle. So we're still in, aren't we? Under rule, and we're not out to here. So which one's better? Well, it's not better. They're just not fitted yet. They're not as good as they could be. You ready? What if we were to change them just a little bit? Well, I could add a little more time to that 10. Now let's take it out here to a 50, okay? So now we're drawing from this point to this point. I could get short any time in here, and I'm not out, and I'm not out, and I'm out over here. But now my trend line, I get into the same spot. I'm still not out, but I'm out here. I didn't lose as much money. Oh, so what's the answer? Well, maybe a 40. Okay? But let me ask you guys a question. I like the idea of expansion and compression as helping me make decisions in and out. But as far as trend line trading goes, I'd rather use a trend line than a moving average as a trend line. Okay? I just think it's cleaner. It's just easier, ultimately. That makes sense? Good. Okay. Let's move into the next section. Let's move into the next section, and it's called the market makers. Now, at the bottom down there, it says, these are the guys we battle every day. And I want you to think about that for a moment, okay? We don't really battle against Goldman Sachs. We're not really fighting Lehman Brothers or JP Morgan. What we're doing is we're both competing for the public's dollar. Goldman Sachs wants to sell to Joe, and I want to sell to Joe, okay? I'm not trying to beat Goldman Sachs. I'm trying to get Joe. All right? I'm trying to get him to make a decision to buy from me. Conversely, if I wish to buy, I'm trying to encourage Joe to sell to me, not Goldman Sachs. Goldman Sachs isn't going to sell to me on the bid. He's on the bid as a buyer. Okay? So we're competing for the same business. I want you to think about that. Now, we've already talked about the definitions of market makers, but let's go back through it real fast. Okay? First off, the market maker, by his very name, needs to make a market. He must be constantly maintaining a bid and an offer in any given security. And he must honor his prices for 5 seconds. This is called the firm quote rule. Okay? So when Goldman Sachs shows up at the inside ask and says, I want to sell $10, 1,000 shares, he must remain there for 5 seconds or until he's hit. Now, they do have an out. If he's hit for 1 share of that 1,000 displayed, he has the right to fold tent and go away. At the end of 5 seconds, he has the right to fold tent and go away, or refresh seamlessly. Now, we were just talking a little bit about the NASDAQ workstation level 2, okay? This machine is a computer that allows them to constantly show the same quote. Even though he says, I want to sell 1,000, he may really want to sell what? 100,000. Now, we have the same capability on our platforms. It's called the reserve system. And if we wanted to sell 1,000 and we had 10,000, well, we could display 1,000 at the ask, and every time it got hit, it refreshes seamlessly, so we don't blink off. It just stays there. The difference is what? We pay 10 commissions. Okay? He doesn't pay commissions. What does he pay himself? He's the broker, for gosh sake. So he can do as many transactions as he wants. Now, this is why we were counting earlier today when we were looking at GVRC, and I said he's up there with 5,000. He just got hit. And we saw him go from 5,000, I think it was down to 3,200. Okay? But he stayed. So as soon as he stays, he's good for another 5 seconds. And another 5 seconds, and another 5 seconds. At the end of any given 5 seconds, he has to make a choice of turning off and redisplaying at another level. Now, this was Van's question earlier. Why do they show on level 2 a bid for a penny and an offer for 1,000? Because they are required as market makers to constantly fill the legal requirement of maintaining a bid and an offer. Now, not all market makers want to play novellas today. They may wish to play it tomorrow. So they have to maintain a bid and an offer today, albeit a non-competitive one, well away from the market, so that nobody messes with them, but they're fulfilling the legal requirements. If they're missing from the bid or the offer for more than 5 minutes, they are banned from trading that stock for 20 trading days or 1 trading month. Now remember that they wear 3 different hats. They do their own trading just like you and I do. We're trying to take advantages of the market. We're trying to buy low and sell high, okay? Hopefully to the public at large, or maybe to a market maker who's making a foolish move, okay? But that's what our job is. Well, they do that too. In fact, 47% of Goldman Sachs's income is for trading on their own behalf, okay? That's a lot for an institutional group. They also then trade for customers, individual customers. Certainly, you guys are aware of Merrill Lynch and Smith Barney and E-Trade and Ameritrade. Well, they're retail outlets, okay? And they're dealing with Joe, and he buys his 100 shares of Cisco and sells his 100 shares of Adobe and all that. In any case, the last one, of course, is they trade for institutions. These may be other brokers, banks, or mutual funds or hedge funds. And that's where we have to watch out, because that's really large share size. That's big stuff. And again, they could be displaying 100, but selling 100,000. And we need to be able to watch the prints and watch their actions to determine if that's indeed what they're doing. Simply put, market makers buy low, sell high, and buy low all day long, back and forth, okay? By the way, somebody told me that if you wanted to open a private account with Goldman Sachs, that you have to put down $3 million before they say sir or ma'am. It cuts out the riffraff. Now, we need to divide these guys up, and I want to say right up front that there is a lot of blending. These guys aren't perfect, okay? But certainly what we call the wirehouses or full service houses, these are the people like Smith Barney, like Merrill Lynch. They handle everything. They'll handle your annuities, they'll handle your life insurance, they'll take care of your stocks, your options, whatever's in your portfolio. They give a lot of technical analysis. They give a lot of recommendations. You all have heard the upgrades and downgrades from these different people. Their main objective is order flow. They need to see a lot of shares come through their coffers, okay? And of course, they collect commissions. Surprisingly enough, most of the full major houses are still charging a very high fee. You know, most of the common commissions right now, I would say, are probably around $7 to $10. But certainly Merrill Lynch and some of the other guys are still charging $29.95, even online, where you don't have to talk to somebody, where they have very little overhead in it. So they still get a lot of money out of the commissions. And these, of course, are people, like I said, Merrill Lynch, Prudential's just been bought out by Wachovia, Smith Barney, Payne Weber was bought up by Morgan Stanley and is gone. Then we move down into the institutional firms. And these are the big battle wagons. These are the guys that come in there with share size every day. And that's what's going to be the distinction between institutional and investment banks. Again, what does it say up here? They're dominant in the pension funds, mutual funds. So who are Goldman Sachs, Morgan Stanley, Salomon Brothers, and Lehman Brothers customers? Well, they're all the famous names you guys know. Fidelity and Oppenheimer and Janus Fund and Ben Franklin, Franklin Templeton, Vantage, Vanguard, all those big ones, okay? So when they're in there, they have the foremost market research. One of the things you have to be aware of is that obviously, I told you, nothing is said or done in this business without a purpose, okay? But again, they have to be very, very careful what they say in the case of banks and stuff like that, because they can't mess with a major company too many times before that bank isn't, or that fund isn't going to do business with them. On the other hand, the other guys can fool the public over and over and over again. Okay? This brings us down to investment banks. Now, investment banks are, they're people who put special projects together. Okay? Needless to say, they're usually very large projects. They do an awful lot of initial public offerings. In other words, they underwrite companies that want to go public, and they'll usually trade their shares for them to kind of stimulate it. They also might find a couple of venture groups together, capital groups, and bring them together and say, what do you guys need? And they say, well, we need 1 million shares of Cisco. So they go out and they purchase all the Cisco. It's a big share, but it's a very limited buy. They may only be there for 2 or 3 days to collect it all. So that's what makes them different from the institutional firms. Goldman Sachs is going to be in there grinding 1 million shares every day. These guys are going to show up and demand or dump, okay, large share size for a short period of time and then disappear. So somebody like Montgomery or Cowen, Hembeck and Quist or J.P. Morgan Chase, they could be in the market and be the hammer today, but you may not see them for a week in that stock, okay? They may not be there for a while. And then all of a sudden they show back up and they throw things out of kilter occasionally because you're so used to having Goldman Sachs being the hammer, but today we have hammer for the day, J.P. Morgan Chase, okay? Because they're in there with a bigger share size and a more dedicated, got to get it done job attitude, okay? Then we have wholesalers, okay? It says no retail role, no stance on any particular stock. They don't do any research. If anything, they're the market makers for institutions. Now, interestingly enough, do you notice that we threw Schwab in here? And one of the reasons is because Charles Schwab lays off so much of their order flow to other people that they actually act more as a wholesaler than they do as like a Merrill Lynch market maker where they're grinding the market. They're trying to just move order flow through, and they'll be selling it to other people like Knight Trimark, or excuse me, it's no longer Knight Trimark, I keep saying that, it's Knight Securities now, okay, or Herzog or M.H. Myerson or Sherwood or Tosco. Now, when you'll see these guys all the time up in the inside market, at the inside bid and the inside ask. And all they're doing is swapping shares back and forth for a couple of pennies a piece. But then they're doing large share size. And this is one of the things that really keeps those prints streaming all the time, already, are these guys doing work. So what if Merrill Lynch needs to borrow a cup of Cisco from Goldman Sachs? Well, then it would be somebody like Knight Securities that would bring it over. Okay, oh, sure, run this over to Merrill Lynch for me. Okie doke. Small commission, thank you, thank you, thank you, thank you. That's all they do is pick up small commissions everywhere. Now we have the regional firms, okay, and these guys are more or less like us. They're just bigger, okay? So if we have a Goldman Sachs who's a battle cruiser, and we're the little PT boats in between, well, these guys are kind of like, what, destroyers, tin cans. Bigger than we are, but still fast and agile, already. They still have big guns on them. They observe every trade and have limited exposure in the market. They don't take home positions. They don't buy inventory. Like I say, they're pretty much like day traders, just on a larger scale. Dane, Piper Jaffray, Wheaton, Southwest Securities. Now, I stuck Midwest Stock Exchange in here because if you remember from the earlier section, we talked about Midwest Stock Exchange as an unlisted trade privilege. Okay, they're not an ECN, and they're not really a market maker, but they act more like a market maker than anything else, so I had to throw them in somewhere. But we can't get to these guys through Super SOs or SOs, alrighty? The only way we can talk to them is through SelectNet. They're not an ECN, and they're not a market maker. They're a UTP, unlisted trading privilege. Now again, no one market maker is privy to all orders, but they have the most powerful thing in the world, and that is the order flow book. Now, just like any other guy in a business, each one of them knows what their sphere of influence is. For instance, if Merrill Lynch is the largest retailer, he probably knows that he holds, and I'm being arbitrary here, but he says, I have 50% of the retail market. You've heard that before, you know, Toyota has 22% of the auto sales in the United States. Well, let's say Merrill Lynch says, I have 50% of the retail market. And he looks down at his order book, and there's 1 million shares to buy on Acme. Does Merrill Lynch now know how many shares there are to buy of Acme in the United States? If 1 million is 50%, he knows that there's 2 million shares that are trying to be bought. Because Joe is going to be pretty much common whether he goes to TD Waterhouse, he goes to Smith Barney, or whether he goes to Merrill Lynch. By knowing what my ratio is of the market, I can calculate how many total shares are going to be bought or sold. Alrighty? And with that knowledge, I know where to take a position in the market. If I know that there's going to be 2 million and that's extraordinary, I'm going to buy some for me right now. Then I'll put all these other orders in, okay? And all these others' demand will drive the price up, and I'll be a happy camper. Could that happen? Yeah, absolutely. I've already said this once, but market makers with the most orders today get the most orders tomorrow. And this is what makes that last half an hour of the trading day so dangerous. Because everybody's looking at each other and they're going, give me that order, give me that order. And they kind of try to get in body and squeeze them out like a basketball guard trying to box them out, okay, and getting those extra orders. So Janus Fund says, well, let's see, Merrill Lynch handled 1 million for me today and Goldman Sachs handled 2 million. I'll give the orders to Goldman Sachs tomorrow. Merrill Lynch is going, rats. We wanted that extra thing. We wanted those extra commissions, okay? Again, market makers basically scalp, and I say that in the general terms, all day long. Remember, I just showed you 6 different things, you know, retail and wholesale and institutional and investment banks. Do these guys blend? Sure. Merrill Lynch does handle some institutional trading. Goldman Sachs does do some retail sales. Certainly Goldman Sachs is famous for underwriting IPOs, as well as the investment bankers. So there is a blending of all this. I wish it was really just, this is all they did, because then we could really pigeonhole them. But that's unfortunately not the way of it. Now, we've talked a little bit about head fakes and some of the tactics they pull on you. And traders use a whole lot of different terms. You can call them boogeymen or scarecrows or market caps or gatekeepers, as we mentioned. Let's take a quick look at one here. Here's a scenario of Goldman Sachs. He needs to buy, and he must need to buy everything because ultimately he does, all righty? But he wants it cheap. He knows that everybody watches him. These people aren't unaware, okay? They know that when Goldman Sachs shows up on a level 2, everybody's going to react to it. So if he needs to buy a whole bunch of Cisco, okay, how does he sit there and get it without raising the price, without having the price just jump out from his sheer presence? Well, one way, of course, is to put a cap, a lid on the market and hold it down. And here we can see, if you look down the columns on the left, you see Goldman Sachs with 1,000 and Merrill Lynch with 1,000 and 100 and 100 and at the bottom 500. But on the ask, we see 200, 100, 400, 88,000. Doesn't that seem a little odd in this universe? Okay? I mean, it sticks out like a red thumb. Okay? So what has happened here? Well, Goldman Sachs has called up Instanet, and said, listen, we need you to put out an order for 88,000 at this price. But what is the intent? Does Goldman Sachs really want to sell this, or does he want to buy the 9/16ths? He wants to buy the 9/16ths. Guys, there's only two kinds of traders. There's winners and there's losers. If it's close to the end of the day and a winner is up, and all of a sudden he looks up here and he sees 100,000 shares up for sale. The supply is enormous. This stock is not only not going up, it has the potential of going down. Alrighty? So he's going to say, it's late in the day. I'm just going to sell out to the bid, get my money out of this, and I'm done for the day. That's what the winners are going to say. What about the losers? Okay? They're going to say the opposite. They're going to say, I have to quit right here and do it again. So there's only two kinds of traders, people. There's winners and there's losers. If it's close to the end of the day, what are the winners going to see? They're going to see this huge share size up here, this massive supply, and they're going to say, you know what? This thing not only has very little chance of going up, it has a lot of chance of going down. So I'm just going to sell out to a willing buyer to the 62 and 9/16ths. What then of the losers? They're not even thinking, could it go up? How much further could it go down? How much more could they lose? So in a little bit of panic, they sell to the inside bid. And who sits there like a spider in a web but Goldman Sachs saying, I only want to buy 1,000. Okay, so if you guys work with me, you can see all the red prints. 1,000, 4,000, 34,000, 35,000, 37,000, 38,000, 39,000. Throw in the chump change, just in red there, there's over 40,000 shares that the only person buying that price is Goldman Sachs. It's working. It's working really good. In fact, he's got them so buffaloed, he has a couple of them jumping out. They can't even wait in line to give it to him. They're selling it to Merrill Lynch and the guys below at the halves. That's what these purple guys are. Oh, get me out. Just get me out. So it begs the question, is this a legal order? Well, yeah, absolutely. It's perfectly straight legal. But the intention, of course, is not to sell stock. Okay? It's to buy stock. It's to scare people down so that Goldman Sachs can say, I only want 1,000 and suck it all up. And of course, once again, if Cisco is streaming at this point at 60 to 65,000 shares per minute, he only needs 1 or 2 minutes to suck up 100,000 shares. He just got 40 right there. Okay, so that's only what? 65,000 per minute, that's 10,000 a second, right? No, every 10 seconds. 6,000 per 10. So, I don't know. How much is that? Come on, math majors. It's late in the day.